All right, welcome back to The Explainer. Today, we are zeroing in on an absolutely massive event that's dropping on Monday, May 4th, 2026, and that's Palantir's Q1 earnings. Honestly, this isn't just your standard quarterly update. This is a high-stakes, binary event that's going to test the absolute limits of their AIP flywheel. So let's jump right in. To really grasp the tension heading into this print, you have to look at the options market. Right now, it's pricing in a massive 10.55% earnings day swing. Think about that for a second. Wall Street is bracing for explosive volatility in one direction or the other. If you're tracking this stock, this is literally a make or break moment, and the stakes honestly could not be higher. Here's our quick roadmap for today. Number 1, the high-stakes earnings setup. 2, unpacking Palantir's strengths. 3, weaknesses and competitive threats. 4, opportunities for future growth. 5, the competition. And lastly, the May 4 scorecard.
Okay, Section 1, the high-stakes earnings setup. Let's start with the hard numbers. Wall Street consensus is calling for $1.54 billion in Q1 revenue. That's a 74% year-over-year jump, which is huge. And for EPS, or earnings per share, they're looking for 28 cents, up 115%. But here's the thing that makes this setup so incredibly unique. Management already raised their full-year 2026 guidance back in February to $7.19 billion. That is the most aggressive guide of literally any large-cap AI software company out there right now. So the central question we're answering today is, can Palantir's actuals meaningfully beat these already sky-high expectations?
Moving on to Section 2, unpacking Palantir's strengths. The incredible growth acceleration Palantir logged at the end of 2025 tells a super compelling story. Total revenue in Q4 grew 70%. That was their highest growth quarter ever as a public company. But you really have to notice the striking juxtaposition here. U.S. government grew a very strong 66%, sure, but U.S. commercial completely exploded by 137%. That massive acceleration in the private sector totally validates the momentum narrative that the bulls have been writing. Now, the engine behind that commercial explosion really comes down to their artificial intelligence platform, or AIP. When you stack Palantir up against other data giants, the difference is night and day. Think about it like this. Databricks helps you build AI. Snowflake hosts your data, but Palantir's AIP, it actually deploys AI directly into an operator's daily workflows. And through their signature 1 to 5 day boot camps, Palantir's engineer this totally unique land and expand machine. They're taking simple 1-week pilot programs and flipping them into multi-million-dollar annual contracts. It's wild. And meanwhile, their traditional bread and butter, government revenue, isn't just plateauing, it's actively compounding. Take a look at these two massive catalysts that just dropped in April alone. First, the USDA awarded Palantir a $300 million sole source blanket purchase agreement to build a unified digital record for U.S. farmers. On top of that, the FAA Logistics Center issued a sole source justification naming Palantir as the only responsible source for its data modernization. That positions them as a finalist for the gargantuan $32.5 billion FAA SMART program. So when you combine that explosive commercial growth with compounding government contracts, you get what is arguably the rarest profile in software at this scale. Seriously, in 2025, they delivered 56% overall growth alongside 9 consecutive quarters of GAAP profitability. We're talking actual bottom-line earnings here, reaching an incredible 43% net margin. Throw in their strategic partnership with Snowflake, where Palantir sits at the intelligent workflow layer right on top of a client's existing data warehouse, and it's super obvious why Wall Street is captivated. Why does this matter for your portfolio? Because true profitability combined with hypergrowth is basically a unicorn in this market. Let's pivot to Section 3, weaknesses and risks. We have to methodically run through these internal vulnerabilities because they're real. First, and absolutely most crucially, Palantir trades at the highest revenue multiple in all of large-cap AI software. The bull case is already fully priced in, meaning any Q1 beat has to be massive just to justify this nosebleed valuation. Second, while U.S. commercial is booming, their international commercial growth is lagging pretty heavily, sitting at just 28%. Third, they carry significant concentration risk. Roughly 37% of their total revenue is tied up in just a few U.S. government sectors, like the DoD. And fourth, high stock-based compensation dilution is still happening. It's slightly declining, sure, but it remains a standard bear case argument. There's also a deeper architectural risk we need to talk about. Palantir is model agnostic. Basically, this means AIP does not rely on a proprietary foundational large language model. They don't actually own the AI brains that they're integrating. So here's the crucial takeaway. If the foundational model builders out there start developing their own native workflow tooling, the value of Palantir's integration layer could get seriously squeezed. Moving right along to Section 4, Opportunities for Future Growth. Okay, so what's next? There are some massive, underappreciated vectors for expansion over the next few years. The absolute easiest win for them is selling AIP into their existing Foundry client base. We're talking behemoths like Airbus, BP, and Unilever, who are still only in the very early innings of AIP adoption. Furthermore, the defense spending tailwinds right now are historic. The Department of Defense and Intelligence Community pipeline could easily exceed $5 billion from FY26 to FY28, just based on current public solicitations. Add in their explosive growth in the U.S. healthcare vertical with partners like the Cleveland Clinic, plus major international government wins in the UK, Germany, and Israel, and you can see they have a very, very long runway ahead. Section 5, Competitive Threats. Now, let's break down the existential threats that are actively trying to compress Palantir's growth. First up, you've got Databricks and Snowflake. Both of these guys boast over $5 billion in annual recurring revenue, and they actively use consumption-based pricing to lure developers in. Then you have Microsoft Fabric. Because it's bundled into existing Microsoft E5 enterprise software licenses and Copilot agreements, Palantir constantly runs into the dreaded, well, we already have Microsoft objection from clients. Plus, heavy hitters like Anthropic, OpenAI, and Google are increasingly building agentic workflow tools directly into their own platforms. And finally, there's a political risk to keep in mind. Future administrations could push for procurement reform, which would definitely threaten those highly lucrative sole source contracts Palantir relies on for government growth. And finally, Section 6, the May 4 Scorecard. We've brought all of this data together into a definitive binary checklist for the actual earnings print. If you're walking this stock, write this down. For a bullish outcome, revenue absolutely needs to clear $1.65 billion. Anything between $1.55 and $1.60 billion is honestly already priced in, and hitting that could trigger that 10.55% downside swing we discussed at the start. The full year 2026 guide needs to be raised above $7.4 billion. A simple reaffirmation of their $7.19 billion guide will likely sink the stock. And finally, U.S. commercial growth needs to stay above 110% year over year to keep that hypergrowth narrative alive. If it drops below 85%, expect loud alarm bells from Wall Street. Beyond those hard numbers, analysts are going to be fiercely scrutinizing management's qualitative commentary on the earnings call. You'll want to keep an ear out for 3 specific things. Number 1, AIB bootcamp pipeline metrics. Specifically, look at the customer count and how those bootcamps are expanding annual contract values. 2, listen very closely to how CEO Alex Karp differentiates AIB against native model vendors like Anthropic. How does he frame that moat? And 3, watch for pipeline color, quantifying exactly when that $300 million USDA contract and the FAA SMART programs will actually hit the books. Which brings us to a final, really provocative thought to take away from today's analysis. For long-term investors, the entire thesis essentially hinges on this one question. Is AIP to enterprise AI what Foundry was to enterprise data? If Palantir has truly engineered a 5 to 10-year compounder that just flawlessly deploys AI into the heart of global business workflows, well, then May 4th is just another stepping stone. But as we've seen on the scorecard today, the margin for error is razor thin. So what do you think the numbers will reveal? Thank you so much for joining me for this explainer, and stay focused out there.